Dear students, I am back again. In this video, I am going to discuss about value-added method of estimating national income. So without delay, let us begin. Before I get into the details of this topic, let me explain you what is this method. Product or value-added method is a way of computing the national income of a country. This system is also known as output or inventory method. This method calculates national income by adding value to a product at every stage of production. Now let us know, what does value added actually mean? On the screen you can see the formula for value added. Value added is equal to value of output minus intermediate consumption. Now we have to understand what does value of output means here. Here, value of output stands for the market value of goods and services produced by a business firm during a financial year. On the other hand, intermediate consumption here stands for the value of non-factor inputs like the value of raw materials. Let me give you an example. Suppose a baker buys flour worth rupees 100 from a miller and then converts that flour into bread worth rupees 120. Now you can see here that flour is a intermediate good valued at rupees 100 and its value is regarded as intermediate consumption. On the other hand, bread, an output product valued at rupees 120, and here it is regarded as value of output. Therefore, the difference between the two is rupees 20, and this is why it is the value added in this example. I hope now you could understand the concept. Let me change the slide. Another important concept which I must explain to you is double counting. Double counting is an error whereby a transaction is done more than once. For example, cost of intermediate goods used by a business firm to produce a finished product are included in national gross domestic product. Since the final price of the good already includes the value of all the intermediate goods which are used to produce it, including the price of intermediate goods, when calculating GDP would involve double counting. Now it is time to do a practical. Let me move to the next slide. There is a question or problem before you on the screen. Here there are two firms, X and Y. Domestic sales by firm X means that the firm X sells some of its output within the country, and remaining portion of the output the firm exports to other foreign countries. So domestic sales plus exports will give you the total output of firm X, and purchase by firm X is clear. As we know, value added is equal to output minus intermediate consumption. So that is why we have to add item number 1 and item number 2 and deduct the item number 3 from the total. I mean, it will be 6,000 plus 1,500 minus 450. In the next slide, I will show you the solution in details. As you can see, the sales by firm y is 3150 and there is no export by y. What does it mean? It means firm X is MNC whereas firm Y is not MNC. I mean multinational corporation. Now firm Y purchases 1400 worth rupees intermediate goods. Output sale value is 3150. So simply what you have to do, you have to subtract or deduct the purchase by firm Y from the sales by firm Y in order to obtain the value added by firm Y. Here you will be able to see the solution in details. The solution I have already explained to you in the previous slide. So just pause this video and note the information on the slide on your note copy. With this, we came to the end of this lecture session. We have two more methods to discuss, which we will discuss in the upcoming classes. If you have any question, as I always say, post to me via WhatsApp or email. Thank you so much.